Hi there. Welcome to another edition of Ask Spurrell CPA. Today we're talking about the components of your financial statements, and I'm here with Laura Neville. Laura, thanks for being here today. So, Laura, you joined the firm a little while ago, and tell us about your background, your education at MacEwan.
Sure, absolutely. So I'm on my fourth year in the Bachelor Commerce program, and I chose an accounting major. This semester I'm taking an international business class with a focus on economics, and next semester will be a taxation class specifically for income tax returns, corporate and personal. And in some classes I'm at the top of my class.
Right on. Well, thanks for being here today, and thanks for sharing that. So, the statistic that goes along with this topic is 80% of all small business owners, Laura. So 80% of them would score less than 70% on a basic business financial literacy test. So, which sounds like, okay, that's not so bad. It's actually, pretty bad if you're running a business. So these are things like, what is an accrual? What are the things that affect the cash flow of your business? The majority of business owners are going to get some pretty key questions wrong. So this is the components of your financial statements, understanding them. It's important for most business owners. The story that we get is business owners, they're not familiar enough with their financial statements to make day-to-day decisions. So they're kind of looking at their bank statements. They're not really using their financial statements, whether they're reliable or not. They just don't have enough confidence in their own ability to read them. So this is what thing that we're trying to bring some awareness to and trying to increase the financial literacy of the average business owner. So what do you think are the questions that the average business owner should be asking when it comes to the components of their financial statements?
Okay, well, I think one question would be, what are the three main question components of your financial statements?
So the three main components of your financial statement is your income statement, your statement of retained earnings, and then your balance sheet. So income statement of retained earnings, and then the balance sheet would really be the three components that you're looking at.
What is a balance sheet?
So the balance sheet, your balance sheet is like a snapshot in time. If you could stop time at a particular moment, these are your assets and these are your liabilities. So these are the things that you own, and these are the amounts that you owe at a particular point in time. So it doesn't address a range of time. It addresses a particular point in time. If someone were to stop the clock at midnight on that day, this much is in the bank account, and we owe this much on the credit card.
Why is the balance sheet most important?
Well, the balance sheet, really does show what assets and liabilities that the business has. So it has all of the resources that the business has to work with in terms of cash or receivables that, the business is owed money, or inventory that the business can sell, as well as all the obligations that the business has in terms of these are the accounts payable, which is the amount that is owed to suppliers, and the balances of loans. These are the amount that is owed long term to the lenders and the financiers of the business.
What would you say to an entrepreneur who look at the income statement without looking at the balance sheet?
Yeah, that's one of the common issues we see with business owners. Is they probably can understand the income statement a little better. Maybe it's a little more intuitive. So they tend to look at that income statement in a vacuum. And the problem with that is there's often mistakes with interim reporting. Most interim reporting, so when I say interim reporting, it's reporting that's done before the year end. So it hasn't been subjected to the review or the scrutiny of a CPA. So often there's mistakes on these balance sheet, and these mistakes on the balance sheet will kind of mask really significant errors on the income statement. So the business owner thinks that they're making money or thinks that they're losing money, and they're relying on this income statement, and they're deciding to buy equipment or hire new staff or lay off staff based on this income statement. but the entire thing is unreliable because there's a mistake, a glaring error on the balance sheet. So really what those business owners need to understand is you need to look at the balance sheet to identify if there's any anomalies before relying on that income statement to make significant business decisions.
What items are on your balance sheet?
So the items on the balance sheet, starting, right at the top is the cash. It's the most liquid asset that you have is the cash. Moving down, you're going to have the accounts receivable. These are the amounts that your customers owe you that you haven't been paid yet. Then you get into things like inventory. So these are the products that we have available to sell, but we haven't yet sold. Then common components like the property, plant, and equipment. And these are the trucks, the machinery, the buildings that are involved in the business. And at the top, those assets are grouped as assets, and they'll be totaled as assets. Then moving below that, you're going to have the liabilities. So these are the accounts payable. These are the loans payable in the business. Then moving down, we'll have the equity section. The amount of share capital in the business and retained earnings, and the total of the liability and the equity will equal the total of the assets, and that's why they call it the balance sheet.
What is an income statement?
So an income statement, unlike the balance sheet that shows you a snapshot of a picture in time, the income statement is covering a period of time. So from January to December, or from January 1st to January 31st. So it's showing how much money was generated in that time period and what expenses were incurred in that time period, working down to a net number, or the net profit or net loss, the difference between the money brought in and the amount of expenses, again, in a time period.
Is the same as a profit and loss statement or P&L?
Yeah, the income statement is the same as a P&L. It's just nomenclature. Most formal financial statements from Canadian accountants, they're going to call the income statement an income statement. A lot of software developers will call it the profit and loss statement. So if you're looking at Intuit QuickBooks, they're going to call it a profit and loss. But there's no difference. It's tomato, income statement, profit and loss. It's the same document you're looking at.
What are the items on the income statement?
So starting from the top of the income statement, you're going to have the revenue right at the top. Now, right under the revenue, you're going to have the cost of sales. So these are the direct cost of sales. So for example, if you're a contractor, you're going to have, the price of the contract is going to be the revenue, and then all of the wood and the supplies and the nails and the subcontractors, those are your direct cost of sales. So under that, then you're going to get to your gross profit. So after you paid the costs that were directly attributable to that sale, you get a gross profit. Now moving down below that, you're going to get into the general expenses. These are things like rent in the office, the amortization of equipment, the office supplies, the utilities. Lots of times these are expenses that would occur regardless of if you had the job or not. And then below that, you're going to have the total of those general expenses. Below that total, you're going to get what's called an income from operations. And that income from operations is how much the business makes before any other items. So, and then below that income from operations, you'll get things that don't directly attribute to the operations, things like tax. We often put the owner's salary there, and then finally you get to the net income or net loss of the business.
What is the statement of retained earnings?
So the statement of retained earnings is almost like the cumulative balance of the income or profits left in the corporation. So if a corporation starts from zero and it makes $100,000, that retained earnings will be $100,000. And then the dividends can be paid out of that retained earnings. So it's basically the earnings in the corporation less the dividends that have been paid out over time. It's a cumulative, kind of a running total since the beginning of the corporation.
How many pages should each of these statements be?
So it's really important that these statements, you want them to be limited to one page. You want to be able to review your balance sheet and review your income statement in a single page. because one of the issues is always, this needs to be a really succinct document that you can use to make business decisions. You can always drill further into the general ledger to see individual transactions, but if you can't fit all of your assets and liability on one page, and if you can't fit all of your revenue and expenses on one page, it gets very difficult to make business decisions over time. So it really needs to be a document that can be on one page so the business owner can efficiently make business decisions. So I think that's the time we have here for today. Just as a reminder, we always, if you're interested in learning more, we do offer free consults. Feel free to give us a call, and we'll set up a free consult. We're always happy to meet with business owners. And if you have any other issues that you'd like to hear us address, feel free to leave us a comment below, and we'll try to address any of those items or questions that you have in any future videos that we do later on. Thanks very much.